This is Economic Foundations, Episode 4, Stocks and Exchange-Traded Funds, Ownership, Capital, Allocation. Today, we define the instruments that connect investors to companies and markets. Stock A. Stock represents partial ownership in a company. When you purchase a stock, you acquire a claim on earnings, assets, future growth. Shareholders may receive dividends. They may benefit from price appreciation. Stocks are not guarantees. They are participation in enterprise risk. Common stock. Common stock provides voting rights and residual claims on profits. Common shareholders are last in priority if a company is liquidated. In exchange for higher risk, common stock offers higher growth potential. Control and volatility coexist. Preferred stock. Preferred stock combines characteristics of stocks and bonds. It typically offers fixed dividends and priority over common stock in case of liquidation. Preferred shareholders usually do not have voting rights. Preferred stock emphasizes income stability over control. Dividend. A dividend is a distribution of a company's earnings to shareholders. Dividends may be paid quarterly, semi-annually, or annually. Stable dividends often signal mature, cash-generating businesses. High dividend yield does not always indicate strength. Sustainability matters. Earnings per share, EPS earnings per share, measures a company's profit divided by the number of outstanding shares. EPS indicates profitability on a per-share basis. Rising EPS may signal growth. Declining EPS may signal operational pressure. However, EPS can be influenced by accounting adjustments and share buybacks. Interpretation requires context. Price-to-earnings ratio, PEE ratio. The PEE ratio compares a company's stock price to its earnings per S share. It reflects how much investors are willing to pay for 1 unit of earnings. A high PEE may suggest growth expectations. A low PEE may indicate undervaluation or risk. Valuation depends on growth, stability, and macro conditions. Price reflects expectation. Market index. A market index tracks the performance of a group of selected stocks. Examples include broad market indexes and sector indexes. Indexes measure performance benchmarks. Investors use them to evaluate relative returns. An index does not predict, it measures. ETF, Exchange-Traded Fund. An ETF is a fund traded on an exchange that holds a basket of assets. ETFs may track indexes, sectors, commodities, bonds. They provide diversification within a single security. ETFs combine accessibility and structure. Passive investing. Passive investing aims to replicate the performance of a market index rather than outperform it. It minimizes trading and reduces costs. Passive strategies assume market efficiency over long time horizons. Return aligns with market performance. Active investing. Active investing attempts to outperform market benchmarks through security selection and timing. It relies on research, analysis, strategic allocation. Active strategies accept higher cost and risk for potential excess return. Skill determines outcome. Liquidity of stocks. Stock liquidity refers to how easily shares can be bought or sold without significantly impacting price. Highly liquid stocks trade frequently with narrow spreads. Low liquidity stocks experience wider spreads and higher volatility. Liquidity affects execution efficiency. Share buyback. A share buyback occurs when a company repurchases its own shares from the market. Buybacks reduce shares outstanding. This can increase earnings per share. Buybacks signal confidence or capital allocation strategy. Capital returned can take the form of dividends or repurchases. Both reflect distribution policy. Closing stocks connect investors to enterprise. ETFs connect investors to structure. Ownership carries risk. Diversification distributes exposure. Valuation reflects expectation. Markets reward discipline. This has been Lecture -01. Next episode, bonds.